If you own more than one dental practice, let me ask you something. Do you know which one of your dental practices is performing better? Or are you just looking at which one collects more? Because higher collections do not automatically mean higher profit margin. I have seen a 1.2 million location make less money than a $900,000 location. You ask why? Because owners were comparing revenue, not performance. Today, I'm going to show you how to properly compare dental practice location performance using clean financial structure and the right margin metrics. Here's the mistake most multi-practice owners make. They compare total production and bank balances, but they do not compare EBITDA margin, profit margin, employee expenses as a percentage of income, dental supplies as a percentage of income. Without standardizing the numbers by percentage, you cannot compare fairly. One location may have higher rent, another may have an associate model, another may have marketing spend. If you're only looking at revenue, you're missing what actually matters. And that leads to wrong decisions, like investing more in a location that is actually underperforming. If you haven't met, my name is DJ Bhola, and we specialize in bookkeeping and financial reporting specifically for dental practice owners. We help practices get clean, updated monthly financials so ownership can make better decisions with confidence. On this channel, we focus on clear numbers, better decisions, and higher profits for your dental practice. When comparing dental practices, you must standardize everything as a percentage of income. Income is 100%. Then compare employee expenses. The target should be about 31% or less. If location A is at 29% and location B is at 36%, location B's profit margin will decrease significantly even if collections are higher. Dental supplies, target 5.58% or lower. If one office is at 5.5% and another is at 8%, that difference directly reduces EBITDA margin. Dental supplies must be categorized correctly, not mixed with office expense. Lab expense, target 5.86% or lower. Lab costs directly impact EBITDA margin. Higher lab cost percentage means lower EBITDA margin unless fee increase proportionally. Advertising and promotion. The target is 2.5%. If one location is spending 5% on marketing, but production is not increasing, profit margin decreases without any return. Facilities and rent. Facilities average is about 8.59%. Rent average is 6.96%. Rent is part of facilities average. Facilities average also includes other items like utilities, security, etc. Occupancy costs may vary by market, but they must be reviewed as a percentage, not just dollar amounts. EBITDA margin. For a single practice, EBITDA margin averages around 35% or more. For group practices, EBITDA margin is closer to 17%. If you own multiple locations, your blended EBITDA margin may fall somewhere in the middle. But the key is this: compare EBITDA margin by location, not just revenue. Let's go through an example. Let's say you own two associate-driven dental practices. Remember, associates are typically paid between 28% and 33% of collections. In this example, we'll just use 30%. That compensation is an operating expense, and that is one of the primary reasons why multi-location practices often operate around a 17% EBITDA margin. Let's look at location A. Collections, $1.2 million. Associate compensation, $360,000. EBITDA margin is around 18% and EBITDA is $216,000. Location B. Collections, about $900,000. Associate compensation is about $270,000. EBITDA margin is 16% and EBITDA is $144,000. Most owners immediately say location A is stronger, it's bigger. And yes, location A produces more EBITDA in total dollars. Now let's evaluate performance properly. Both locations are operating near the expected 17% EBITDA margin for associate-based models. So the question becomes, why is one at 18% and the other one at 16%? Let's look at the expense structure. Location A, employee expenses 35%, dental expenses 7%, lab expenses at about 6.5%. Location B, employee expenses at 30%, dental supplies at 5.5%, and lab expenses at 5.8%. Even though both offices pay associates the same 30%, location A has higher operating expenses in key categories. Those increases reduce EBITDA margin. Now, let's make one adjustment. If location A reduces employee expenses from 35% to 31%, which is the normal average of a dental practice, that 4% improvement on $1.2 million equals $48,000 in additional EBITDA. And that is $48,000 in additional profit without increasing any production, without increasing fee, without adding any patient, just better cost control. That is why comparing percentages of income, not just revenue, matters. Better structure drives EBITDA. And associate compensation already reduces margin in multi-location models. Everything else must be managed carefully to protect it. Here is what proper comparison requires. To compare locations properly, you need identical chart of accounts across all locations, consistent categorization, dental supplies separate from office expenses, associate pay separated from employee expenses, monthly reporting, not quarterly, percentage-based reports. When each location follows the same structure, performance becomes clear. Without that structure, comparisons are misleading. Here is the takeaway. Bigger does not always mean better. Revenue does not equal profitability. The location with higher EBITDA margin, controlled employee expenses, stable dental supplies percentages is typically the stronger business, even if collections are lower. If you want to grow multiple locations successfully, you must compare performance the right way, because what you measure improves. If you own more than one dental practice and you're not reviewing percentage-based performance monthly, start there. Standardize your chart of accounts. Clean up your categories. Track EBITDA margin and profit margin consistently. And if you want structured reporting built specifically for your dental practices, that is exactly what we do. Clear numbers, better decisions, and higher profits for your dental practice. I'll see you in the next video.